Welcome to the next in a series of webinars brought to you by PKF Texas. This time we are joined by Patent Training and the FinOp Exchange in the presentation of this webinar. We were pleased to welcome PKF Texas Audit Director Nicole Riley to present What's New Broker-Dealers, Year-End Accounting Updates and Reminders. This presentation was recorded live on December 13th, 2022 as a Zoom webinar. All information was accurate and current at that time. Those viewing this recording now are not eligible to receive CPE credit from PKF Texas. If you have questions regarding this or future webinars, please feel free to email us at jlemansky@pkftexas.com and we will get back to you as soon as possible. Well, welcome everyone to today's webinar, What's New Broker-Dealers, Year-End Audit and Accounting Updates and Reminders. We want to thank you all for joining us today. We're pleased to present this in conjunction with Patent Training and the FinOp Exchange. So shout out to them. Thank you guys for partnering with us on this. Just a few housekeeping things. Everyone who attends this live webinar today will receive CPE credit administered by PKF Texas. In addition to attendance, you will need to answer one of the polling questions in order to be eligible for CPE, and there will be 3 throughout the presentation. Nicole's happy to answer questions throughout her presentation in addition to the Q&A time at the end. So please submit your question through the chat button at the bottom of your screen. And just to give you a little bit of background about Nicole, if I can get the slide to advance, there we go. She's an audit director here at PKF Texas and is one of the leaders of our broker-dealer team. She's been providing auditing and consulting services to broker-dealers for 15 years, and she works closely with her clients in meeting reporting regulatory requirements while providing value and helping them make smart business decisions. Nicole, go ahead and take it away.
All right. Well, thank you guys for spending your morning with me for an hour. We did set this up as a Zoom meeting instead of the webinar function because we wanted you guys to be able to unmute yourself, ask questions, be on camera. I love to actually see people rather than just talk to the blank screen and talk to myself. So very excited that we have a couple people on camera. Feel free to be on camera if you want. The slides will be sent out afterwards, so don't feel like you need to just copy the slides or scramble to get everything off the slides. I will go ahead and send them out to everybody after the presentation. A quick objective, really I wanted just to I wish I could make you an expert in everything that we're going to go over in less than 60 minutes. But unfortunately, I probably can't. There are whole day webinars on some of the new standards. And so we're going to kind of fly right at 30,000 feet. If you have a question, speak up. We can dive in a little further. But really, my goal for everybody today is to be aware of where are some of these things that are out there, and to be able to maybe at least acknowledge that it's there, look into it more if it applies to your organization, or if you come down the line in the future and have those issues, you'll at least have a baseline of information to rely on and can then dive in a little bit deeper, know where to look. If it does feel like rocket fire, because I am going to try to talk about various different, I'm going to talk about a little bit of some FIN regulations and notices. I'm going to touch on ISC 0606 reminders. We're going to hit new accounting FASB standards. So we're going to hit a lot of different topics. So if it does feel like rocket fire, please feel free to ask a question, but just wanted to give that heads up as we dive in. And then the last intro before I dive into content is just this disclaimer that on our presentations, these are my opinions, it's general information, facts and circumstances and all that. This is not to be considered consultation, and if you'll need to get with an advisor to really dive into details for real consultation. All right, with that, first topic I'm going to hit is one of the FINRA hot topics from a recent presentation that there is this thing out there, the Vidalia letter. For those of you that have below investment grade related or single rated debt securities, want to be aware that this is out there. Essentially, back in 2000, FINRA did a letter to Charles Vidalia about criteria on marketables of certain securities and the haircutting requirements. There was some confusion, apparently, because in the letter it had A, B, C, D, and between D there is an or listed. And the confusion became then that there were some advisors and some individuals that believed that because that one specific or that it was an or between all 4 criteria, which was not actually the case. So there is a new no action letter out there that is much more specific and dove into those 4 criteria to give a little more clarity. If you do have these kinds of things, recommend you going to read that no action letter to get that clarification. Next, going to dive into a few recent regulatory and information notices. Obviously, this is not an all-inclusive list by any means, and just kind of, I picked out the ones that were more applicable to accounting related issues, net capital, those kinds of, the really more the FinOps side than the compliance side. Obviously, there's a couple things out there with digital assets. If you're into that, definitely go read those interpretations and notices. But first and foremost, wanted just to remind you, FINRA does their little cheat sheet of your due dates every year. So they did release that in November, that information notice in November, which is the 2023 filing due dates. Oh, and that's quarter 20 or 2022 report filing due dates as well. So your annual report due March 1st or March 31st, depending on if you take advantage of the extension. Information notice, go back, Jen. Information notice in April. This is just a general FYI. So if you are involved in the formation of new broker dealers, this is probably a good read for you, as they did do some modifications to their intake function and the new application program. And then last on this slide is Reg Notice 2131, just kind of an FYI, since this is new, they established new supplementary liquidity schedules, but it is applicable to carrying members that have those specific that meet those specific thresholds there as described at the bottom of that slide. All right, next wanted to talk on Regulation Notice 2127, as this did update interpretations in the financial and operating rules. There is a few more than just this. So this, again, not an all-inclusive, but the kind of the big highlights and the big ones that FINRA has been emphasizing and talking about. The first one there in 3.1 on page 226, it gives you the reference there is right on service agreements. Service agreements with parent subsidiary broker dealers is incredibly common. I see it a lot. So this is, I think, really applicable to a lot of individuals. And it's really a reminder, your service agreement needs to be in writing at the time that the services are provided. And all of this, the reason for these rules is so that the payments from the broker dealer to the parent won't be considered capital withdrawals. As you know, there are limitations on capital withdrawals. So these kinds of things, you want to make sure that they properly qualify into the service agreement payments management fee that's being charged by the parent. So make sure it's in writing. The interp does specifically point out that utilizing a % of the broker dealer's net income may not be deemed a reasonable basis. So that's kind of a big thing that they put right there in writing. If you are allocating expenses or your service fee is based on a net income, percentage of the broker dealer compared to the parent combined, that may not be held up in an examination with them, essentially because the service being provided normally doesn't fluctuate based on the broker dealer's net income. And that's why they wanted to point that out. Also, make sure that the services relate to the broker dealer. That seems to be a given. And the parent actually has to have the ability to provide the services. Specifically, they pointed out that if the parent is doing accounting services, or that you're being charged for accounting services, but the parent doesn't have accounting personnel, then that would not be an appropriate charge from the parent to the broker dealer because they don't have the ability to actually provide that service. And during the FINRA presentation, when they were talking about this, that I watched, they specifically pointed out that this differs from the expense sharing agreements, because the expense sharing agreement really has 3 parties involved, where it's the parent, the broker dealer, and the landlord. So where you're sharing expenses and that percentages, versus the services agreement is where the parent is actually providing the service with their staff. And then a reminder that expense sharing agreements were back in Notice 0363. The other big thing that this reg notice talked about was unsecured related receivables and payables. This, again, it's not super new, but so you may be aware, but you're allowed to have receivables up to the related payable as an allowable asset. But there are really specific provisions in the interpretation that you need to meet. There has to be there has to be specific written agreement between the payee and the broker dealer. It has to specify that they won't get payment until the broker dealer is paid. So you'll want to read that very closely and make sure you have those additional provisions in place for if you're going to use this provision to have assets for an unsecured receivable with a related payable. The next and again, this one may have snuck by some people, but really wanted to just mention it and make sure that touch on one of the specifics. Reg Notice 2105 that allowed the 30-day extension on our annual reports. So allowing you to go to the end of March to get your audit report in rather than the end of February or March 1st. Interestingly enough, about 90% of member firms of FINRA qualify for this exemption, but only about a third did take it in 2021. You have to have net capital less than 50 million and be in compliance at year end. That's a big provision, big caveat. You have to be an exemption report filer, another big caveat. You have to make written notice to FINRA, which actually isn't all that hard to do. It's really just an email to your FINRA rep, letting them know that you're going to take advantage of that. But the other one that I think did catch some people or didn't get caught was you have to be an electronic filer. So you need to set up an EDGAR account with the SEC and get that profile, and you have to upload your annual report to the SEC through the electronic EDGAR portal. They also want to just give you a heads up. This is not something you want to do on the due date. If you're going to take advantage of this, I would recommend getting your EDGAR account set up ahead of time, get everything set up so that when it comes time to file, it won't be a problem, because there is some lead time necessary for that electronic filing setup. Last but not least on that one is there was the COVID relief on manual signatures and notaries. And as of now, that has not been revoked and is still in place. So just kind of a FYI, if you are taking advantage of that COVID-19 relief. Well, just as the exemption reporting continues to be a hot topic and a hot button with FINRA exams, as well as if your audit firm gets examined by the PCAOB. Interestingly enough, I don't think I know multiple exemptions didn't really exist and nobody ever considered that prior to PCAOB examining firms and really getting into the nitty-gritty of the examination rules and the reporting. I think they're the ones that brought it up the first time. They're obviously on your focus report, there's really wasn't a place to have multiple exemptions. You had your membership agreement, it had the exemption in there. So really this has kind of become a hot topic since Dodd-Frank and PCAOB got involved. As a reminder, I have the link here for the FAQs. They are really helpful if you're finding that you may have multiple or if you need some guidance. And some of the topics here, making sure that your exemption reporting is for the current fiscal year and is all inclusive. So it's something that you do need to look at every year. If you have changed your business activities, if you've entered into new agreements that aren't similar, you've kind of expanded and growing, this may be something that changes in the future. If your exemption report does not match your current your member agreement, you should get with your FINRA representative to get that updated and changed. And the other piece of that is kind of a heads up and a cautionary is you do want the exemption report to be accurate, and you want to make sure that your exemption report does is all-inclusive and has everything that you are doing. But you also need to be aware that if there is an exemption that you claim that is not a business that you're approved to do, that could be an issue with other FINRA rules. So, for example, if you are a $5,000 net capital broker dealer and you put an exemption of K2I in your exemption report, that is going to be an issue because K2I requires the firm to be a $100,000 net capital firm. So just kind of being aware that this does interplay and making sure that you're good on all fronts there. Multiple activities, you would claim multiple exemptions. So be aware that that is happening and does happen, and you should make sure that you claim all the relevant exemptions. And hopefully your audit firm does challenge you if they are seeing that you're in multiple business lines on that, because it will be an issue for the firm on their examination from PCAOB. And as many of you may know, we saw a lot, you have a lot of firms that do have footnote 74 firms here. So we are, that was established and brought out in July of 2020. So that is something to consider and be aware of, where essentially a footnote 74 is where you just don't have customers, so that your business activities would never put you into a position where you would have customer funds to have those issues. And then also the focus report should properly reflect that your exemptions that you are taking. Definitely something that's getting a lot more scrutiny by regulators on not only the firms, but on the audit firms as well. All right, that was the big notices and information notices that I wanted to talk about today. So next I wanted to jump into some 606 considerations. 606 is several years old now for the broker dealers. You guys did have to implement this at the same time that the public companies did. You didn't get the relief that the private companies did, but wanted to touch on a couple of things because FINRA is still seeing issues in this area and with the reporting. So first and foremost, always consider the facts and circumstances of the revenue streams that you're having. And you may have certain business lines that you actually have to look contract by contract to determine your revenue recognition. The M&A and the investment banking deals are a big one in this area, because we're seeing that sometimes you have a point in time fee agreement. There may be non-refundable fees that have to be paid up, but essentially the agreement has one performance obligation that you are going to help this company sell their business. You get paid the whole amount at the time that the deal is done and secured, even though you may have non-refundable pieces of deposits that may, because your performance obligation is a point in time recognition, those non-refundables may not be able to be recognized as revenue until the deal is done. So you do need to consider all of those aspects of 606 and consider that versus, in M&A and investment banking, we do have other deals and agreements where it's more advisory and you will get paid over time because it's not contingent on the actual deal going through. I've also seen where agreements with the customer have both pieces of this, where there is an advisory component as well as essentially a success fee. So you need to evaluate whether what the actual performance obligation in the contract is, and then you recognize the revenue in accordance. Soft dollar arrangements are also a hard one because they may or may not actually have a written agreement. So that's another one that I think is a area you need to take a look at, because there are aspects of the broker-dealer business that are pretty straightforward. Trade date is a known, for regular commissions, regular trades. Trade date is where your performance obligation is met and you recognize revenue. So a lot of those are pretty straightforward, but you do have to catch the ones where you don't settle right away and have receivables. But the other common deficiency that we're seeing is when you have outside trades. you have your clearing firm, and then some of your advisors have trades going on with maybe an insurance company on the outside that is not held with your clearing firm. And those are coming in the mail after the fact. You need to be aware if you have those and be recording the receivables appropriately. If those trades are happening, obviously there's a delay in actually getting those payments in the mail or the wires coming in. The other one piece to consider is under 606, there are now contract costs that could require capitalization. So if you're, a normal commission for a trade is recognized as expense at the same time the commission records revenue. If you are a firm that provides incentives and upfront bonuses to somebody when they bring in a new client, there could be, not say there, you got to look at the facts and circumstances, but there could be a position where that upfront bonus would need to be capitalized and amortized over the life of the customer. So if you have unique situations where there is upfront bonuses or contract costs at the front end paid, consider whether or not those could be capitalized and not just expensed right away. The EY technical line, if you just Googled this, they have a relatively good, it's a good resource that has a lot of very broker-dealer specific revenue lines or revenue transactions and revenue considerations under 606. I think that's a great resource to look at. And if you're looking to beef up your footnotes in your financials, because obviously your auditor can't prepare these, but the AICPA has a good, and I put the link in there, the AICPA is a good little, it's kind of a cheat sheet of footnotes, essentially, that they're pretty good footnotes that lay out the revenue recognition of a lot of the major business lines that broker-dealers have. So definitely recommend looking at those if you may need to beef up your footnotes, or you're looking for somewhere to start. Especially if you're a new client, new business line, definitely a good resource there. All right. Well, just some general reminders, and I found this interesting, but FINRA is still seeing issues where the broker-dealer books and records are not on the accrual basis during the year. And they are not happy when they see the monthly focus reports not matching up with the annual report. So they do not want to be seeing annual accruals being done that have never been done in the past, or putting, first you should not implement a new standard in December if it's going to impact your monthly reporting throughout the year. So be aware, and unfortunately you guys are held to quite a bit of a higher standard than a lot of small businesses, because we are in PCAOB standards. They do want you to be implementing those standards right away at the beginning of the year. But they are seeing issues with that. And then I also wanted just to point out, if you haven't previously had to do lease accounting, because you guys should have, the broker-dealer specifically should have already implemented lease accounting under 842, but the parents often are now, actually the 2022 is the year the parent is having to implement it. So I did keep some of this in there. But on the broker-dealer side, if the broker-dealer is on the lease and you did implement 842, Reg Notice 1908 has guidance on how those lease assets and lease liabilities should be reported on your focus report. Another thing I wanted just to talk about on the FINRA side was some of the examination and risk monitoring issues that they're finding, especially related to net capital. There are, on FINRA's website, they do have their findings, and they list it out by individual category of what they were finding. And the net capital one, I think, is most applicable to this group. So I wanted to just point out the things that they're seeing in their examinations and errors, so maybe you can learn from others' mistakes. Obviously, the classification of receivables, liabilities, and revenue has always been a challenge on some things, making sure you net correctly, lease liabilities and assets being correctly classified. The other one, incorrect capital charges for underwriting commitments, being aware that the moment by moment capital always is appropriate. They are finding issues with that. And also in the underwriting commitments, knowing what role your firm is taking and how that impacts your net capital is very important. And that's where they're seeing a lot of issues as well. The firm not knowing if they're a best efforts firm or a firm commitment firm and how that impacts their net capital. So being aware of what role you play in an underwriting in an IPO deal and how that impacts your net capital on a moment to moment. Because a lot of times it's in and out in a day, but there are requirements in the in-between. The cash to accrual that we mentioned in the previous, that they're seeing a lot of cash basis and then accrual is not being done until year end. And then even though expense sharing agreements, the notice was issued way back in 2003, the notice 0363, they continue to see insufficient documentation around expense sharing agreements. So if you haven't looked at that notice in a while and you do have an expense sharing agreement, maybe worth a revisit and a reread to make sure that your agreement specifically complies, because your agreement itself needs to have the method of allocation for payment, the allocated expenses. You need to maintain sufficient documentation to substantiate those methodologies. So you want to make sure if the schedules are maintained, the allocation is reasonable. And it is interesting when FINRA does talk about this, and I have heard, when they say reasonable, they say, you know it when you see it is what they consider reasonable. So there isn't a lot of definition of what's reasonable and what's not. But, as we saw before, based on net capital or net income, that may not be an appropriate allocation method. Maybe gross revenues would in certain circumstances and for certain expenses, but may not be for others. So you do need to kind of look at that and make sure it's fair, it's reasonable, it's consistently applied. Those are the big highlights there on the expense sharing agreements. And gave you, I put the link to where that risk monitoring guide is on FINRA's website for you as well. That concludes my FINRA specific items. And next I'm going to flow into essentially what's happened at FASB and the new standards that are out there and are applicable for either have been applicable for the public companies or starting to be applicable for the private companies, since I know we have a lot of organizations on the call that are not just, it's the broker dealer, but then there's the related parent too. So reference rate reform, basically what this is it gave everybody a relief where you didn't have to apply contract modification rules for debt agreements and other similar lease agreements, where the only thing that changed in the agreement is the rate change because LIBOR is sunsetting. I'm actually not seeing a lot of this in practice. Most of my clients, the agreements in place are maturing before LIBOR is totally sunsetting. So they're able to actually do a normal amendment and a normal renewal before they have to apply. But this does actually end in December of this year. So we won't have to deal with it next year. If you have modified a contract for just to change the LIBOR to something else, you don't have to apply the contract modification rules. Next, wanted to point out ASU 2021-10, which is government assistance. And because of all this COVID relief, there we go. FASB recognized that there isn't a whole lot of guidance for corporate clients. And the nonprofits have a whole section of how they deal with government assistance, but the for-profit entities have very little guidance. They did not give us accounting guidance of how to record government assistance, but they gave guidance on the required disclosures if you get government assistance and follow the topic 958 of nonprofits or IS 20. in the international standards. So essentially, if you get a government grant and you treat it as a contribution under the contribution guidance of 958 or IS 20, you have additional disclosure requirements now starting in 2022. That was not effective for 21. It is now effective for 2022. Hopefully we won't be seeing a lot of COVID or grant relief like we did in the past, but if you do get it in the future, making sure you apply those disclosure requirements. It's mostly accounting policies used, line items affected, significant terms, and information on it, which a lot of organizations already did with PPP and ERC credits. So we've seen a lot of this already disclosed in the financials. Next is ASU 2021-08, and this is specifically on business combinations. So if your organization has a business combination where they buy another firm, or your firm is purchased and you have to apply purchase accounting, this is a really good one. It's again it's actually a relief on the filers and the businesses. It makes your life easier. And essentially what it says is if you have contract assets and contract liabilities that are in accordance with 606, you get to just use the carryover method essentially from the previous books and records. You do not have to fair value those assets and liabilities. Public entities, this starts after you can early implement, which I would imagine. So I'm guessing anybody entering a business combination here on forward is going to be applying this and just going to use the 606 rules, not have to fair value your contract assets and liabilities. ASU 2021-07 relates to stock compensation. And just to give you a little background and where we see this in most companies, so a lot of times profit interest shares, we don't see a lot of actual stock comp, but it's usually like there's shares awarded to employees as incentives, some kind of another. The complicated piece when you get to non-publicly traded businesses is the valuation methods. A lot of people use the Black-Scholes model, but the one piece of the Black-Scholes model that becomes complicated is you are required to use the fair value of the underlying company shares. So you're having to come up with the fair value of the shares of the business that's not publicly traded. And essentially the guidance in FASB has pulled in, has specifically included items that we've already and historically been using, but it does allow a 409A, which is used for tax valuation. It allows that to be used as a reasonable method of valuation for the company, and it also allows a couple of these other things. Sorry, my dog is going crazy with the delivery of a package. But if you want to go to the next slide, Jen. It also gives you 12 months of one of the items that you're using for the input. You can use that for a period of 12 months. So the big one is if you have a 409A valuation done for your tax side, you can now use that in valuing your stock comp for a period of 12 months, which usually you're getting one every 12 months anyway. And it can be elected on a measurement date by measurement date basis. And of course, you have to disclose because this is a practical expedient. And so it's supposed to make your life easier and it's able to be used going forward. A couple slides on intangibles here. Some of these are a little older, but a reminder. With goodwill, we no longer have step 2. We got rid of that, which is, again, making our lives a little easier, which is great. And now we just have step 1. If you do have to do a impairment charge. And all that means is when you determine the fair value and the carrying value, that's where you stop now. And whatever the difference between the carrying value and the implied fair value that you determine, that's your impairment. Previously, you had to do that step 2, which then essentially was purchase accounting further to do the fair value of individual assets and liabilities. So we no longer have that aspect in GAAP. A more recent intangible ones is 2021-03. And this is another one that Goodwill, in making life easier with COVID, it became very difficult to figure out when and if we had a triggering event during the year. And so now FASB has allowed us to have a practical expedient where we only look at triggering events at your year-end reporting. So you at year-end, you evaluate the year in total and consider whether or not there was a triggering event during the year, rather than on a moment-by-moment basis. Under fair value measurements, we had some clarity on equity securities when they're going back and forth from whether unrestricted equity securities and whether or not that restriction should be considered in determining fair value. So that's a good one. If you have equity securities with restricted sales, and you have to consider those at fair value for your business. And essentially, it's saying that you only discount your fair value if the restriction is on the equity security itself, not if the restriction is on the specific owner of the securities. And because of the group of individuals I have, if you do have investment companies in your portfolios or within your businesses, there is very specific transition guidance for the investment companies on this one because of the impact that it could really have on those investment companies. So if this applies to you, you'll need to look at it in detail, but especially if you have investment companies that this could impact, you would want to look at that. And it would be those investments that are being fair valued and they are applying a discount for restrictions on the sales.
And Nicole, we did have a question in the chat. What is PCAOB major focus on BDs for 2023?
PCAOB has been super focused on revenue recognition, and they are big on making sure the broker dealers are preparing their own financial statements. They continue to see firms preparing the financials and impairing their independence. So they're very big on talking about that. And which is a hard line because as an auditor, we want to help our clients and we want to provide guidance, but we do have to be careful of how far over that line we step and how much guidance we can provide in the preparation of the financials, obviously. So that's a big one. The revenue recognition seems to be something that they are blindly focused on, and which I find interesting because as I mentioned, like 90% of the firms are non-carrying firms, most of which are also privately owned and, in my opinion, don't have a real incentive to overstate their revenue like a public company does, because you're not doing revenue, like you're not releasing your revenues to the public, you're not giving out that information. You don't even have to publicly provide your statement of operations. So it's interesting that that is such a high priority item, but I know for sure in their exams, there's continually finding errors in the auditor's work around revenue. And then they've also been looking at SOC reports and the use of SOC reports and making sure that the valuation of those is adequately done and considered. And then the broker dealers are properly monitoring their use of a service organization. So for those of you, obviously your clearing firm is your big service organization. And then the other one that I see normally is your payroll company. And so they've been very focused on the work papers around those and our walkthroughs and our understanding to make sure that broker dealers have the controls in place that, like, the user entity, or they call them user entity controls. So in the SOC report, there's usually a whole page of things that the broker dealer is responsible for and they need to make sure they're doing on their side, reviewing exception reports, looking at making, whatever is given to them is gone through a proper review and approval process, that the outputs are reviewed and approved in a timely manner. Those are all things that we're definitely seeing them stress a lot more in finding examination findings on. And I do have to say, the one thing I've listened to PCAOB talk on multiple occasions, and the one thing I find most frustrating with them is they love to show you all the findings that they had in their exams, and they love to very much categorically make it very high level, and they never give you great examples of what it is that was really the problem. But that's my annoyance with PCAOB personally. So, all right, the polling question, going back to that, we are seeing good, almost 81% have implemented 842. That's awesome. And about 19% have not. So I won't spend a ton of time on this because the bulk amount of the group has already implemented it. So I'll skip ahead. I wanted just to show I'm a very visual learner. So I find visualization really helpful. And I wanted just to kind of point out, I don't see a lot of capital leases in this industry, but if you do have them, your balance sheet really didn't change much with those capital leases. As you can, this is a illustration of the before and after implementing 842 for capital leases. And then this is the example of what it looks like when you implement the operating leases. Obviously very, very different on the balance sheet side. And you can see the big, huge asset, right of use asset that's non-current. And then you have a liability that is partially short-term, partially long-term. So very, very different on the income statement or on the balance sheet side. The income statement really shouldn't have changed much. Most of the expenses is still it's all still straight lined. So your expense side, your EBITDA should not have been significantly impacted. It's just your balance sheet. If you want to go ahead, the couple of reminders, big one, you need to evaluate your right of use asset for impairment. For those of you, this applies to everybody, especially those of you who have implemented it. You do need to consider impairment on a right of use asset. You can't just ignore it. It might be a pretty easy, most of the time it's probably going to be a pretty easy memo because you're in the space, you're using the space, you have the lease through 20 whatever, but you do have to acknowledge that. And then, the other one, here's just a lot of more details. Let me skip ahead and go to some practical experience. There are some practical expedients listed in here for when you do, for those of you that haven't implemented, I've listed a lot of those out that give you some relief and some make it a little bit easier in multiple aspects. If we go to the implementation considerations, obviously you need to definitely educate your stakeholders here, consider softwares. Our firm currently has Lease Crunch. If you would like, and I have a few slides here that give what Lease Crunch looks like. It's actually very user-friendly, gives you the reporting details you need, gives you your footnote details that you need. So depending on how you've implemented, as a reminder for those that have implemented, your footnotes have to segregate your operating versus your capital leases. You have to have your weighted average of your remaining years, your weighted average of your discount rate used. So especially as you continue, it was pretty easy year one because your weighted average was probably the same and you use the same rate for everything. With rates changing so much, as a reminder, it is not an average, it's not a straight average, it's actually a weighted average calculation that you have to include here. Other aspects, the other one I also like to mention on the 842 that I think is helpful and as a kind of a reminder is I've reminded firms you can use similar to property and equipment, you can use a minimum threshold, like a capitalization policy. Most firms, the copier and the postage machine lease are probably not material enough to include in your under the standards, technically, yes, they're supposed to be included. But if your postage machine as of right now, even at the beginning of the whole lease, is $1,200 as a capitalized asset. I would argue that that's probably not material and probably does not actually need to be included and could just be just because the implications are very immaterial. Copier leases are really similar too. We're seeing, they a lot of times what the capitalized asset would be 2,500 or 3,000, and that's less than your capitalization policy. If you have like a $5,000 capitalization policy, all the administrative tracking into it is probably way more expensive than it's worth, and it's just not a material impact to your financials. Would recommend you talking to your audit firm about that before you apply on a total basis. Have what's reasonable. Obviously, for various different firms, your size is going to very much impact that, what's reasonable and what's not. So, but a practical expedient, something to consider, and to have a internal policy around that, just like you do have a PP&E capitalization policy. All right, CECL. This is the one that is actually coming down the pike a whole lot soon. This is futuristic. It's very big impact on financial institutions, banks, credit unions, those kinds of organizations are going to have a pretty big impact. And the overreaching theme here, if we can go to the next slide, is, and my best explanation here is essentially, if you looked at your AR policy and your credit policy, you're very historical looking, and you would look at what's collectible and what's not, and you would usually apply that historical percentage. What CECL is saying is we now need to also include in our allowance and what our loss is future looking. And so we no longer have a probable, like the probable was a higher level. It's what we estimate as reasonable and supportable. And what they're saying, for example, and they have I have the example in here. If you go, this was a little table that they provided, which I thought from the FDIC, where they crossed out loss discovery period. Essentially, you're no longer amortizing that loss over the period of the loan. In this case, with the FDIC, you are going to recognize that loss at the beginning based on what you see forward looking. And the AICPA had an example. If you go to that's the next slide, in their Journal of Accountancy. And it was interesting because it's basically in your AR, the AR historically we collect. So let's just, there's 10% we don't collect. But the current economic trends is, let's just say that the unemployment is down. And when we see unemployment rates dropping, our collection rate actually increases. So because the unemployment rate is so low, our uncollectible balance is likely to be lower than the 10%. And we should really modify that based on the current trends. The big thing here is documentation, because we're going to do this in January and your auditor is going to look at it a month later. So you really want to document your assumptions and the things that you considered, especially the unobservable things that you're forecasting, definitely all just need to be documented into how you got to the allowance that you did. Couple others, there's definitely some more ASUs out there that you can, and they're very specific. But if you do have derivatives and hedging, there's a few others, one out there in 2022 that's applicable. Freestanding equity with call options, those are in there. For those in this with insurance, long duration contracts, that's a little bit of an older one to consider. And then I included a little cheat sheet though, here at the end I think this came from FASB's website, but it's a little cheat sheet of the 2022 standards that are applicable for public companies. And I also have a little cheat sheet that is the new standards that are applicable for the non-public companies that are hitting So you can have a little cheat sheet to look at. Anybody have any questions or comments that they wanted to, any expansion of things? I flew through a few of the last ones, just because and ended up getting done a little. I usually spend a little bit more time on leases than I did. We did want to cover various topics, so it did kind of feel a little bit rocket fire. But hopefully, if you have any questions, please my contact information is here on this slide. I'd happy to talk through things, or if you need have specific facts and circumstances. And then the other thing I wanted just to point out here, we did include the FinUp Exchange link here if you're not a current member. And Deidre, if you want to, we have 2 minutes left. Maybe if you wanted just to remind everybody about what the FinOp Exchange offers and how you guys can be a resource.
Yeah, sure. So the FinOp Exchange is a free service. We started in 2014. Ivana and I had talked several years earlier about, gee, wouldn't it be nice if there was a networking for FinOps? And we charged for it the first couple of years and people didn't pay us. So we decided not to charge for it, but it's a closed environment. If you go ahead and send a question in, I go ahead, it's not fancy. I go ahead and make it generic and send it out to the team, and people then provide answers back and forth. We've been a little dormant lately. We're trying to revise it a little bit. We have about 150 firms on there right now. You're welcome to join. It's free of charge. It just allows us a place to visit and talk. And we will have speakers occasionally like Nicole and PKF. So that was a wonderful speaking opportunity. So, and we've had FINRA before. We've actually got to give comments to FINRA about some of their FinOp type things. So it's fun. It's a good little place where you can have people that do what you do and be able to share information with one another. Thanks, Nicole. That was nice for letting me tell people what the FinOp Exchange was.
Absolutely. Oh, and one last resource. If for those of you in the PCAOB does an annual forum for small businesses and broker-dealer business. They did it in October last, and it was completely virtual this year. It's always free. They used to do them in person several times a year around the country. I don't know if they'll resume that or if they'll just continue this virtual environment. But you can go to the PCAOB's website, look for the small business and broker-dealer forums, and they have the YouTube videos of this last one that is interesting. To be honest, the FINRA one to me was the most interesting of the day, but SEC talks about their enforcement issues, PCAOB talks and gives an update. And sometimes they do more examples, and then sometimes it's more just general information. But another great resource, because I do feel like broker-dealer resources are fewer and far between and harder to find.
Thank you for watching this recording of our Zoom webinar. A quick reminder that watching this video will not qualify you for CPE credit. For more information about PKF Texas's upcoming webinars, contact Jay Lemansky at pkftexas.com and stay tuned for future topics.